step in and deal with. So I would draw that distinction. Final point I'd make is that I think there are, and we drew this out in the report, a number of mitigating factors that we've seen in this particular context, which haven't seen in the past always, in terms of the economy. Two I'd probably draw out particularly. One is that we have not seen a pronounced increase in unemployment. We've seen very little increase in unemployment. That's relevant because historically one of the drivers, and if you sort of analyse it sort of statistically, one of the drivers of loan losses, particularly in the mortgage market, is unemployment. And the second one is associated with that certainly last year we saw actually an increase in around about a 2% increase in household real incomes. Both of those things support, obviously, overall conditions and financial stability in that sense.
A year ago, you're talking about anticipated and unanticipated increases in interest rates.
Yes.
A year ago, this time last year, no one thought that the base rate would get as high as 5.25. That wasn't priced into the market. And I just wondered if there are other things that have surprised you about the performance of the UK economy. You mentioned the fact that employment has been stronger than you would have thought, and the impact on financial stability has therefore presumably been more modest. Is that your assessment, Governor?
Yes, it is. I mean, I think two things I would draw out there. And it's important, I'm going to sort of caveat this, particularly when I talk about households, that of course we have to talk about sort of aggregates and averages, and I want to be very clear that of course there are people who are experiencing very difficult times in this country. So let me preface that with that very important comment, because we recognise there are individual circumstances. Overall, I would say, and this particularly relates to household borrowing in the mortgage market, I think the situation is that there is less stress in that market at the moment. I think we draw this out in the report. We use this thing called the cost of living as adjusted debt service ratio, which is basically sort of taking household income, deducting the cost of essential household spending, and then saying what proportion of the residual income does housing debt servicing cost. And it's interesting to look at that. It is nowhere near as stretched as it was, for instance, during the global financial crisis period. So there is some, as you said, some mitigation in there. Same thing's a bit true with small firms, actually, that, again, the average small firm debt servicing ratio is not as, last year, relative to earnings, was not as stretched as we've seen in previous events.
I'm going to ask about small firms in a minute, and I just wondered if each of the witnesses could tell us what they think for the year ahead is the biggest threat to financial stability. Just choose one. Starting with you, Jonathan.
Oh yeah, if I can just start by just adding to what Andrew said in terms of the markets. So as Andrew said, the unanticipated versus the level of interest rates is important for household and businesses, but also for the market. So volatility and the sharp rise in interest rates is more risk for stability, and that's obviously stabilised. And so although interest rates are expected to remain high, the expected volatility has come down, and so we should expect to see less risk of financial instability in the markets unless that changes. Now, obviously, what that could mean then, if conditions seem calm, if volatility is low, then you could get a risk of exuberance. So people taking on more risk because they think the market is more benign. And obviously
number one risk for you is the risk of exuberance in 2024.
I think that risk, as the risk from sort of historical volatility declines, the risk of exuberance, and we have seen that in some, for example, credit spreads are very tight, equity markets, particularly in the US, are very strong, and so there is something we have to monitor.
Your number one risk. I'm just asking the witnesses to choose their number one risk, and what would your number one risk be for the year ahead, Governor?
Well, I mean, the world, unfortunately, of course, is still a pretty uncertain place. So I think the potential for further global shocks is clearly there. I mean, the events in the Middle East are obviously tragic from an individual point of view. Interesting from an economic point of view, I mean, if you take the oil price, which is an obvious place to look, it hasn't actually had the effect that I sort of feared it might. but obviously it remains a very uncertain place, and there's the
So there are macro-prudential risks from
Yes.
the potential for energy prices to spike higher.
yeah,
again.
and further, as I say, further global
That
shocks.
would be the number one
yes.
you would pick.
Yeah.
Sarah, what would you pick as your number one?
I'd sort of have something that speaks perhaps to both of the issues that John and Andrew mentioned, which is about uncertainty, and uncertainty not being priced properly in markets, because that goes back to what are people expecting to happen, and therefore the risk of an adjustment. So uncertainty about the macroeconomic environment, uncertainty about geopolitics, uncertainty about credit risk, uncertainty about unemployment, and that...
A constant feature of the world, though. I mean, how can you sort of say that that's a particular stress point for you in 2024?
The way we phrased it, and I would underline it, is that the risk environment at the moment feels particularly challenging. It is a trite thing to say that the world is always uncertain, but I do think the set of circumstances that we currently face are extraordinary.
So the unknown unknowns is what I'm hearing. Okay, Carolyn.
I think the thing that worries me the most is that in our base case outlook, at the Bank of England's base case outlook, there's a slowing in growth, but it's not a dramatic one. And I think that's a reasonable outlook to have. But there are a lot of risks out there, as we've just heard about, coming from the global economy, coming from geopolitical risks that could create at once an uptick in inflation, and therefore a need for higher interest rates, but also a slowdown in economic activity. And I think that combination, given the vulnerabilities that are out there, would be stressful from a financial stability point of view. And that's exactly why we do the stress test on financial institutions, to see if they can withstand that kind of shock.
Thank you. I want to go back to the small and medium-sized enterprises, because we've got an ongoing inquiry into their access to finance. And you say in your financial stability report that the pressures on small and medium-sized businesses could pose the risk, one of these risks that you're concerned about, because about 60% of UK employment is in those small and medium-sized businesses. The Basel 3.1 changes, is there not a risk that the changes you yourselves make it more challenging for those businesses in 2024, Governor?
That's one of those changes. We put the consultation paper out, we've had the responses, and we're reviewing them very carefully. I think where we are, we started with a position where under the sort of current Basel regime, all the current Basel regime in this country was implemented when we were a member of the European Union, so essentially it was harmonised European Union rules. The European Union decided to implement something that was not in the Basel factor, and for which they received from the Basel Committee a non-compliant judgment afterwards, which is a so-called small firm factor, which lowered the risk weight for small firms relative to larger firms. I have to say, on a risk basis, there's not a lot of justification for that, but there obviously are other justifications from it, from the point of view of our sort of secondary objectives and the have regards and the PRA's functions. What we proposed originally actually lowered the proposal from Basel, but didn't continue the support factor. We've had feedback. We're looking at it, and what I can say to you is, we're going to try to come out with something that works, frankly, all round, taking into account our secondary objectives as well as our primary objectives. So, we're giving a lot of consideration. We will come out with something, and I hope it will be something that people will feel is a sort of acceptable balance. So we're cognizant of the point.
Are you confident enough to state that whatever you decide, it will not make financial stability more of a challenge for that sector of the UK economy?
The interesting thing is, I have to say that the analysis that's been done over recent times on the relationship between those risk weights and lending doesn't suggest that there was much effect from the concession that the European Union gave in the first place. There's not a lot of evidence to suggest it stimulated lending relative to a higher risk weight. But as I say, I just want to emphasise the point. We're cognizant of the point. We understand that there is an important. Small firms are important. Your point about employment is one I share. So we will try to come out with something that works. Frankly, in that sense, we do understand the point.
Okay, I want to turn to another thing that the bank itself is doing that could potentially have an impact on financial stability. And Sarah, this is something that you and I have talked about in the past, which is the quantitative tightening program and the impact that it has in terms of, real world financial stability. Because although you've been absolutely clear that you're going to be selling 100 billion of gilts in this year, obviously it was something that did have to be paused when the unanticipated changes that have been alluded to in September 22 happened. And I would just like to ask you again whether you think there is a risk that the bank, being itself a seller of 100 billion on top of the issuance coming from the government, that could have an impact on financial stability in 2024.
So I differentiate here between the impact on markets and the impact on banks and financial conditions and reserves. In terms of the impact on markets, sales of gilts could affect yields. We've given some estimates of that. They're relatively small, and we've been really clear that bank rate is our main tool through which we will ensure that the right financial conditions, the right monetary conditions exist in the economy. And the MPC has also been really clear that market functioning is important to how it goes about that programme. We transparently and clearly indicate what our expected programme of sales is, and so far all of the evidence suggests that there has not been an impact on market functioning, never mind financial stability, with the exception of the one event that you mentioned. The thing that we have also started to look at is the impact on banks, because the quantity of reserves, which are a key liquid asset for banks, will reduce as a result of quantitative tightening. In addition, there'll be fewer deposits in the economy, which the banks will need to adjust to as well. And we've emphasised how important it is for banks to take into account these system-wide trends as they think about how they manage their liquidity and their funding. And of course, we remain open for business through our other facilities to ensure they get the liquidity they need. So I think there are a number of channels through which quantitative tightening might matter for market stability and for banks. So far, there's no evidence that that has been a problem.
And you've previously told us that it probably is raising gilt rates by about 10 to 15 basis points, and therefore feeding through into corporate lending rates, into mortgage rates. And is that still your assessment?
It is. There's been no update. And of course, that feeds then into our assessment of what is the appropriate level for bank rate. We take the whole curve into account when determining that.
Okay, thank you. Carolyn or Jonathan, did you want to add anything on quantitative tightening or small and medium-sized business lending?
If I just quickly on Sarah's point about one of the reasons that we're sort of talking about this very early in terms of the liquidity needs for banks is that they obviously have long-term kind of planning, and we just want to make sure that they're sort of taking it very seriously. This is a reversal of some of the sort of extraordinary measures that happened, as a function of first the financial crisis and then COVID, and the level of deposits was extraordinary through that period, and as that kind of and reserves, and as that unwinds, then they should return back to a sort of more business as usual, as it were. So it's supposed to sort of remove the chance of sort of unexpected surprises in the future by being well ahead of it at this point.
Okay. Thank you. Stephen.
Thank you. Governor, good afternoon.
Afternoon. Welcome back.
Thank you. If we look at the countercyclical buffer, you obviously, in response to the pandemic, it was reduced to 0, and then last July went back to 2%. I am assuming two things. Firstly, that we should now look at 2% as the neutral level in a standard risk environment. Could you comment on, the committee got a letter from Sam Woods yesterday, which you obviously would have seen, which says the bank does not consider this has had a material effect on banks' net lending to SMEs. I just wondered whether you could give some flavour as to what the rationale for the bank believing this hasn't had any constraint.
Well, I mean, it's sort of interesting what happened during the COVID period, as you said, because we reduced it very quickly as the COVID period started. And the reason we did that was because we were wanting to, in a sense, guard against the very big economic downturn we had feeding through very quickly into credit conditions, creating credit losses and causing the banks to have a constraint on the supply of lending, because we do distinguish between what I call the demand for lending, which is driven by sort of borrowers' conditions, and the supply of lending given by banks' conditions. And the CCYB is about the latter, in the sense that we don't want lending to be constrained by the situation of the banks themselves. So it was very much a sort of it was a proactive thing to do, to say, we'll release this constraint to enable the banks to lend, to continue to lend, even if they suffer losses on their existing loan books. Now, the interesting thing is actually they didn't suffer losses on that, so those losses did not materialise actually during that period. And so what we found was that the banks had got that capital buffer. That capital buffer just stayed there. Lending, in our view, really followed a path which was determined, we think, more by the demand for lending, not by the capacity to supply it. And so we reached a point as the COVID period was unwinding, in that sense, as the economic effects were unwinding, where the capital was still there. And so we said, well, we'll put it back into the buffer.
I guess the question, when the buffer was reduced to zero, the bank, I think, said that this would be to support lending of up to 190 billion. The evidence from Sam Wood's letter yesterday to us was that actually increased net lending during that period was 23 billion, not 190. And are you going to say that the only reason that, well, I should ask you why you think there was such a difference between 190 and 23?
Well, I think 23 was really, we thought a fairly sort of plausible level of demand for lending. I mean, the 190 was, to use your words, was up to.
Yeah.
That was the sort of maximum arithmetic capacity of that. It didn't mean to say we expected 190 to happen. We made a very sort of what I might call a big move at the start to signal to the banks, you can make loans and not feel constrained. I say the up to 190 wasn't necessarily because we thought there would be 190, but we wanted to make it very clear to the system, you're not constrained.
Might I add just one point on that? Of course, for the larger corporations, not for SMEs, they can source finance from markets as well as from the banking system. And so in taking that decision about releasing the CCYB, we had an eye to perhaps markets not being able to function, and therefore the banks needing to step in scale.
On the basis of the previous decade, you'd had interest rates which facilitated easy access to market-based finance.
Right. If I could just add to that, I mean, if you go back to February 2020 and early March 2020, just as the COVID crisis was breaking, there were very big drawdowns here and internationally by large firms on their, if you like, their credit facilities. And that was another thing that prompted us to move, because these numbers were very big.
Huge.
Now, it turned out that, I mean, those were precautionary draws by firms saying we've got to pile up liquidity because this looks really bad, as you can remember. And in the end, that credit was not needed on the whole. We observed that actually that credit again sat in sort of accounts that came back into the banking system in a way. And so the pressure was relieved. But had that gone on, I mean, at the point when we took that decision, which was sort of mid-March or late March, I think, had that gone on, clearly those numbers were so big that they would have created quite a big draw on the system.
So in the light of the last 3 years where the buffer has gone from the standard neutral down to zero and now back to the standard, can we draw any lessons, or have you drawn any lessons as to where it's more efficacious in terms of, is it more powerful when it's being lowered in terms of the action you want it to take in terms of macro prudential policy, or do you think it's more effective when it's being raised? Or can we not learn anything from what we experience?
I think our philosophy towards it is that actually we do use it, proactively. There's another reason for this, that there are two sorts of buffers that the system has in it. The CCYB is an example of a buffer where we do, quotes, release it, in the sense that we actually reduce the capital requirement. So we say your capital requirement is now this much lower. There's another form of buffer where we don't release it. We say to the banks, it is okay for you to go into the buffers. Now they are, I would say, the second sort of buffers, and it's a question we've got to come back to. I think the banks are a bit suspicious about, well, sort of really okay? Because you haven't lowered the capital requirement. So we do, the CCYB I think is a more powerful buffer, and we do use it proactively for that reason.
And again, if I might add, there's some international evidence that the Basel Committee has pulled together that underlines the point that the Governor has just made, that banks are prepared to use buffers that are released in a way that they don't use buffers that we say are okay to use, which I think supports a steady state neutral setting of a meaningful number, so when stress hits you can release that rainy day capital in case it's needed.
I think we can take it from that. You think that the counter-cyclical buffer is a fairly major tool of macroprudential policy. Can I ask, and can I ask everybody on the committee for this one, in your November minutes or record or whatever of the committee meeting, you, I think, said you stood ready to vary the buffer in either direction in light of evolution of circumstances this year. Can I just ask everybody if they see at this moment, or what would be the case they would argue for a change in the buffer this year at the moment? Is there other things that you are concerned about that lead you to think that we should be watching for an argument for that change?
Oh,
can I start with you, please?
Sure.
Thank you.
Thank you. So we view 2% as being kind of a neutral setting, and the kinds of situations where we would consider raising it above 2% would be situations where the risk to the banking system had increased to such an extent that we thought that more of a buffer was needed to provide that certainty, or at least try to ensure that the banks could withstand a shock without having to really tighten credit in a way that would be bad from the macro-prudential point of view. Obviously, in November, we didn't see that situation. That's why we left the buffer where it was. Contrary, and this is something that's we've done in the past, is if we see conditions deteriorating to an extent where we think that banks might be in a position to restrict credit over and above what they would normally do because of deteriorating credit conditions, but to rather protect their capital positions, then we would consider lowering it. And again, that wasn't a situation that we saw at the time. And so it's important that every time we look at the outlook and make that judgment based on what we see in terms of bank behavior, bank financial situation, as well as general financial market conditions.
Very much the same approach. If financial vulnerabilities are increasing in the system, if we're seeing looser lending standards, if aggregate debt levels are rising, that would be a situation that would warrant, it implies there's greater financial risk in the system that needs bigger buffers. However, if banks are focusing on their balance sheet, worried about losses because of the economic environment and restricting credit supply, that would be the case for reducing it.
Mr. Hall?
Obviously I agree with what's been said before, but just one thing to make very clear again is the word counter-cyclical within counter-cyclical buffer is not counter-cyclical to the economic cycle, but to the financial or credit cycle. And so that then sort of feeds into this answer, which is, when is it most powerful? Well, when the credit cycle is sort of, let's call it a credit boom, then at that point you raise the capital, not primarily to restrain the boom, but because you know that the consequences of a bust, an end in that boom, could be quite adverse. So you're building up rainy day capital at that point. And then, so it's slightly asymmetric, whereas on the downside, you're actually lowering capital in order to facilitate lending that otherwise would be restricted, sort of for unwarranted reasons. And so I think there is this kind of asymmetry. On the one hand, it's just building a rainy day buffer, and on the other hand, it is actually, on the downside, it is actually supposed to sort of support lending to the real economy, and therefore, absorb some of the economic shocks as opposed to amplify them.
Thank you.
Thank you.
Keir.
Thank you. Happy New Year, Governor.
Yeah.
I'd like to turn to the issue of mortgage rates and household debt, if I may, and thank you for your comments earlier about the kind of individual impact on mortgages, because I know in my own constituency just how difficult people are finding it. And when your average owner-occupier mortgager, if they took it out from Q2 23 through to 26, is likely to face increases of £240 a month, I question how sustainable that can be alongside cost of living pressures too. So thank you for those remarks. In that context, how confident are you that there won't be any serious financial repercussions for financial stability in the context of increases in household interest payments over the course of this year?
Well, it's a very good question, thanks. I'd sort of put a couple of things back. I think one is that and here I do want to sort of apply the caveat again about individual circumstances, because as I said before, it's very easy now to talk about averages, which we have to do, but that ignores individual circumstances, which is obviously not the right thing to do. That said, when we look at debt servicing ratios for households, they are by no means as extended as they were, for instance, during the global financial crisis period. So we have this thing which we set out in the report, which is called the cost of living adjusted debt service ratio. I think it's about 1.4, 1.6 at the moment, whereas during the global financial crisis it was around 3, I think. So you have a sense. Now, actually, if you translate that into, as I was mentioning unemployment earlier, it's quite a good thing you could say to me, what would it take to get it back to that level? And I think on the back of our envelope, it's about an 8% unemployment rate. Currently, it's 4.2. Monetary policy forecast, the November one takes it to about 5. So you can sort of see that in that sense, we have got a degree of sort of margin in there, which we haven't had in past crises. And you see that, by the way, also in the arrears rates, which are lower. And one of the things that I think is most important, and of course this is also due to changes in the rules and also changes in the resilience of the banks, that repossessions are now rare. I mean, I think one of the worst things we had in the past was a big upturn in repossessions and the suffering that caused for people. So you see it through that lens, but it's important to watch it. Now, the second thing I'd say, obviously, is that obviously we've now had quite a big change in market interest rates over the last few months, and so that the cost of mortgages is coming down. I'm going to abide by the chairman's comment at the beginning that we're going to come back to monetary policy later, but let's just take the market for a moment. I mean, obviously that is feeding through into mortgage costs, and I think, I hope that is something that continues.
So given what you've said about the labour market and the sustainability of household debt overall, are there particular sorts of households that you feel will have a worse 2024 in relation to their mortgage rates as opposed to others?
Well, I think I may have said this at a previous hearing when I think a question that Dame Siobhan asked me. I think the rental market is more stretched because I think you've got a higher proportion of low-income households in the rental market. Rental inflation is currently on the stock around about 6%, I think. Again, I really hope that will come down, and lower interest rates obviously help that as well. But that, I think, is an important point because that's where you've got a greater preponderance of low-income households. Yes.
And perhaps turning then to the rental market specifically, the bank concluded that banks are unlikely to be severely affected if renters come under further stress. Banks do not have outsized exposure to renters. What are the areas of the financial sector that you feel are particularly exposed to, especially to buy-to-let renting as a sort of specific market phenomenon?
Well, the reason that the banking system is not, I think, critically exposed to buy-to-let is because typically the loan-to-value ratios in buy-to-let are quite cautious, so 75% is quite often sort of the upper margin on that. We are also, I should say, seeing quite a structural change going on in the buy-to-let market that I think there's been a shift, and it's continuing from sort of the smaller buy-to-let owners to the more commercial, larger ones. So you are seeing that shift going on in the market as well. But I don't think the banking system is actually heavily exposed towards the buy-to-let market in a credit condition sense, no.
And for credit card defaults as well, is that a phenomenon of which we'll have to keep close?
Well, we watch it. We
focus
watch all those numbers very carefully for arrears, but we're not seeing substantial upturns in arrears at the moment. No.
Right. And then,
if I might just add, those sorts of issues are the ones that we do stress the banks for in our regular stress tests. So you do see chunky falls in house prices in our stress test, 36%, which does mean that there can be losses on buy-to-let mortgages. We also stress consumer credit very heavily through that as well. And the banks are resilient through that, so they should have capacity to support households, even if economic conditions are much worse than we're
Look, I think
expecting.
that's important, because if you take the charter that the banks have agreed and that the chancellors are involved in creating, that's important, and of course it's more possible to do that with resilient banks.
Mm-hmm. And just finally, on the affordability test, the bank withdrew the test in August 2022. Do you think over the course of this year it has potential to expose us to financial risk in allowing borrowers who are unable to take on mortgages that they in effect shouldn't be?
Shall I take that one?
I'll take it, yeah.
So our analysis is that we don't need the affordability test that we withdrew, as well as the FCA's affordability test and our macroprudential loan-to-income limit. We brought all of those three in together at the same time back in 2014. What we learned through the process of seeing how those tools operated was that we could get resilience in the household sector just by having the FCA's affordability test and the FPC's loan-to-income test. And what we've done is checked our analysis, and what that shows is that we are getting the resilience we need through those two tools. We don't need the FPC's affordability test.
It's quite interesting if you look
well.
at the flow of new mortgage lending and you look at it against the loan-to-income test. So the ceiling on the loan-to, well, the sort of the test, the point on the loan-to-income test is what, 4.5, isn't it? 4.5 times loan-to-income.
That's right.
Now, normally in the low-income period, we saw it sort of sitting just a bit under that, but not much under it. It's come down, so the flow of new lending has come down quite a bit, but that's happening naturally, which I think is a sign that the market is working in that sense as interest rates go up.
So from your perspective, as we sort of look toward 2024, there are no circumstances in which it would be necessary to reinstate the affordability test?
We don't see those, and we included a review of it, and in a sense we committed to reviewing the removal of it, and as we concluded, we don't see that, no.
Okay, thank you very much. Thank you, Chair.
Can I just
Sorry,
mind
please,
if I
no,
just
go.
come in quickly on it? So I think it is fair to say that the loan-to-income test is sort of most binding in very low interest rate environments. And so if you were to see a sort of structural shift, so the natural interest rate was much higher on a long-term sustainable basis, then a loan-to-income of 4.5 times would be less sustainable. And so, one could imagine if you moved that, then obviously we will continue to review the tools in general, but you could imagine, for example, that LTI limit could be moved from 4.5 maybe to 4. You could do that, and given you also have the MCOB sort of affordability test, then those two tools together should be appropriate. You don't need a third tool, but that doesn't mean that we might not want to adjust one of the tools, such as the affordability.
But it's why we review these rules more frequently than almost all our others, because they have such a direct effect on people.
Yeah, I think I would just add, it's really a moment to, especially coming from outside of the UK, to look at the rules that are there. Sure, we make a point of only keeping the rules that we think are necessary, but I think this is a point to say that the increases in interest rates are really hard for people. That's true, especially for some households. At the same time, the fact that we can see a resilient system in the face of such large increases in interest rates is testament to the wisdom of having had these rules in the first place, and we should keep sight of that.
Thank you all. Thank you, Chair.
Thank you. Angela.
Thanks very much, Chair. I want to ask about highly leveraged corporates and whether, to what extent you're worried about what's going on in this particular sector. And in your stability report, you talk about the three different ways that highly leveraged corporates are likely to borrow in leveraged loans, in private credit, and in high yield bonds. And you also point out the fact that in respect to private credit, non-bank financial institutions are those that normally lend, and that there's been a large increase in that sector compared to the more regulated sectors, which might have some rather obvious connotations for financial stability globally. So how do you feel that is going? Are you worried by that? And what do you think you as a committee should be keeping an eye on to try to mitigate those risks?
Well, it's a good point. I mean, it's, I would say, very high on our list of issues to work on and watch carefully, because we do see developments in the market which, cause us to want to understand more about them. I think private credit's a good example of that, actually, it's not as big as leverage lending, but it is growing. I think also in the early days of private credit, I heard people saying, oh, don't worry, it's not leverage. Well, it's not leverage, but it's lending to people who are leveraged. That's the point. So the risk is there, clearly. It is opaque, relatively. I mean, the name private probably sort of gives it away in a sense. It's not done on markets in that sense. And so one of the things, to your question, that we're doing internationally in the Financial Stability Board is that we have to improve the access to information. It's right that we do that internationally, because this is actually very much an international thing. There's more of it in dollars than there is in other currencies, actually, but our banks are obviously in those activities, and our firms are in those activities more generally. So I would say it's not something that we're currently of the view that this is a big risk, waiting to happen, but it is very much sort of, at the top end of our range of issues that we want to know more about, get to grips with, and understand, do we know what all the risks are in this activity?
I mean, which sectors are these highly leveraged corporates in? Is there some gathering together in particular sectors that might set off alarm bells, or is it just spread fairly widely over the corporate sector more generally? Or don't we know?
I think there are some sectors where it is more prevalent than others, yes, I would say. I don't think you can
And
point
what
to...
are they? Are they sectors that we should worry about particularly? Are they volatile, or are they...
Well, if you look in this country, I think, at sort of leveraged lending, I think you can see, transport, utilities,
Water.
Sorry?
Yeah. Some of the water companies.
Well, I have to declare an interest. I'm a consumer of their water, I think, actually.
Yeah. But Ofwat are supposed to be handling that, aren't they?
Yeah.
That's all fine then. Okay, utilities and potential monopolies, where there are obviously going to be customer cash flows, which hopefully help this. Is that the kind of area that they've accumulated in, or is it?
I mean, I think I would say, look, we're interested in the sectoral distribution of it, but actually we're more interested in the sort of the nature of the activity and what risks it gives rise to generically, rather than particular sectors at this point.
It always struck me, though, if one thinks of a private equity financed, highly leveraged sector, you would think of something like social care, nursing homes, and we remember what happened with Blue Circle. If there's a failure in an area like that, there's actually quite a big risk that the state has to come in and deal with it, because one can't simply leave older people who are in nursing homes that have gone bust.
Yes.
In empty buildings. So as policymakers, I suppose we're worried about that, but what extent does that sort of leverage with an idea that even if you fail, you're going to leave costs on the public purse, does that impinge on the kind of work that you do, or are you looking more systemically?
It's not quite classic financial stability, but I think you're right to point to it, because in a sense what you're saying is that it's areas where if the problem arises, there isn't a natural resolution mechanism which not only sort of in a sense addresses the financial stability issue, but also recognises that those sorts of sectors are ones where the service is essential. You know, it doesn't go. It has to have continuity of service.
And water would be another.
Yeah, I mean, we're not the water regulator, obviously, so I'll
sure,
draw
I
the line
understand
there.
that. Yeah, I understand that. Fair enough. But I suppose, again, reading your report, I sort of, my attention was sort of attached when I saw that that 24% of global leverage loans and 29% of high yield bonds are due for refinancing before the end of 2025, and as you point out in your report for people watching, the refinancing has to be of the total loan, so it's not a small percentage. That implies rather a large sort of potential risk, doesn't it? And what can people like you do about that?
I think it's that's where I think we can come in, because it's one of the risks that you see in that lending. It's what we tend to think of as cliff edges, where if there is a very big sort of refinancing cliff, and that refinancing goes wrong for whatever reasons, then the outcome is difficult. I think where we can come in, it's not so much in the borrower case, but obviously in terms of getting the lending industry to understand how do they manage those cliff edges, and not having a means to manage them is not, in my view, an acceptable state of affairs in that sense.
And if I may, kind of coming in and highlighting the issue, pointing out the vulnerabilities and the risks, what we're aiming to do is ensure that the investors who will be asked whether or not they want to refinance these loans come 2025 are thinking about the risks before they crystallise at the time of the refinancing.
Because in reality, if the cliff happens, of course, the investors are not going to get their money out. I mean, that's the other reality of it.
Sure. Are there, thinking about the LDI experience, are there other things like that it hoved into view and crystallised a problem that nobody quite knew was going to crystallise in that way? How do you spot, as a committee, things like that have never happened before, that may happen in the unusual circumstances where we're going from a very, very, very low interest sort of era to one that's in theory more normalised in terms of the cost of borrowing and interest rates? There's obviously volatility and unusual things going to happen in a phase from moving from an odd phase of economic reality into a more normalised one. How do you spot, or try to spot, the sort of lurking things in the markets?
It's a big challenge, because increasingly, and this is true domestically and globally, we're having to spend a lot more time on the non-bank world, as LDI of course illustrates. The non-bank world is a very large landscape. It's
opaque, as you were saying.
Parts of it are opaque. It's very disparate, and so both domestically and internationally through the Global Financial Stability Board, we're having to spend a lot of time on what I call, how do you survey a landscape like this? I mean, give you a few examples, because it is recently areas that are relatively opaque that have caused the issues. So, going back into the sort of earlier part of the sort of COVID period, it was, quite extreme volatility in commodity prices, which caused concerns about commodity financing, which is another opaque part of the landscape, actually. LDI, as you say, and the thing, and I think I've said this before, I think the thing about LDI was, I mentioned the point about volatility earlier. The other thing is that the LDI industry is split between sort of an 85% of it, which was single funds, and a 15% which was shared, which was pooled funds, and it was the 15% that was the problem because of the coordination problem in it. So again, if you come to your question about how do you scan for those things, you are facing quite a challenge at that point, and it's one that we, both domestically and internationally, are having to sort of come to terms with how we deal with this.
Can I just ask, given the relative increase in the size of non-bank financial institutions in terms of this lending, because it's growing rapidly, is there a case for some form of regulation? And I don't mean the same as banking regulation, but maybe a senior executive's registration or something that would give you a handle on what is an increasingly sort of unregulated and opaque but rapidly growing sector.
There's a number of ways you can commit. John referred to something early on, actually, which I alluded to, which is one of the things that I think is important is that if you come at it from a different angle and say, not so much what are the institutions and the markets, but what are the functions, there is often commonality in the functions. So one of the things that is common across these things often, in these abrupt changes in market conditions, is margin calls and collateral requirements. Right. And I think you referred to early on in your point about volatility. Now, one of the things we're doing, say domestically, but particularly internationally, is to say we have to get to grips with this question about appropriate margining practices. Because that's a way to come at quite a few of these areas together to say, your margining practices and your collateral call practices are not robust. That's why we put greater resilience into the LDI market, because they've got to be able to meet these requirements. It's why we have concerns, if you go back to sort of dash for cash in March 2020, a lot of the problem, people say, why is the US Treasury market a problem? It's the deepest market in the world. The problem is when you get these abrupt changes in the market and the margin calls are so big that they cause stress in the market, and then people start dumping positions in a disorderly fashion, and that causes financial stability problems. So you can come at it through these sort of what I call functionally generic approaches.
I'm conscious I interrupted you. I wondered if you want to just come back on.
So I was just going to say a really important thing that we're doing is our system-wide exploratory stress test. We've talked a number of times about how we stress test the banks to see how are they going to behave in bad economic states of the world, and what does that mean for businesses and households, and what do they need to do in advance in order that they absorb rather than amplify that shock. And what we're doing through our novel, never been done anywhere in the world before system-wide stress test is to try and apply those same techniques to this whole system of market-based finance. And that should give us a much better sense both of how these things might matter for businesses and households and the real economy, and therefore what an appropriate regulatory response might be.
Thank you, Chair.
Thank you. Rez.
Thank you. Thinking through on global risks and climate change, clearly there's geopolitical risks right now arising from events in the Middle East. But to what degree are you anticipating potentially any volatility in commodity markets? And in particular, I am thinking of the shipping routes, Houthi rebels and similar. So it'd be useful to get a sense of that.
Well, it's a good point. We've certainly seen, as best we can tell from the monitoring, shipping traffic is being affected. It is being rerouted. That will increase shipping prices and shipping costs. I think initially that will be an issue in the monetary policy world rather than it may feed through into the financial stability world. I would say again, as I said earlier on, one of the things fortunately that hasn't happened is that we have not had a prolonged spike in oil prices. We had a bit of an initial spike. And at the moment we're seeing quite if anything, the oil price is actually coming down a bit, and seems to be some price management to keep it there, which is very helpful, because clearly quite a bit of the shipping traffic that goes through those straits and through the Suez Canal is oil and liquefied natural gas. So we have to watch it very carefully, though, because it is obviously having an effect. At the moment, I would certainly say in the energy side, it's been fortunately, seems to have been managed so far.
In terms of if there were a supply side shock, is the financial sector resilient enough to withstand that?
Well, because we've seen this in recent years, so in a sense we've been through that one. As I said earlier, I think one of the things that did come up a couple of years or so ago, which was interesting in the non-bank world, is that the commodity finance world is quite opaque. In that sense, it's quite a separate section of the financial world in that sense. We did see signs of dislocation in that market. Didn't come to a financial stability problem in the end, but it has caused us globally to have a much greater focus on it. And I think it's something we have to continue to watch, frankly, in that sense.
Yeah. We have a pretty sophisticated business model more generally of supply chain management around the world, which is encouraging. But in terms of the UK's one of the leading global financial centres, and so that financial stability agenda, we need to make sure it continues to be a global effort. It'd be really interesting to hear what your intention is to do at some of the G7 and G20 meetings this year in terms of making sure there is that financial progress, the stability.
Well, I have the joy of chairing the Global Supervision and Regulation Committee in the Financial Stability Board. So yes, I get this directly. So yes, it will be a big focus of attention. I think, and I think certainly, as I say, the potential implications for that world of the Middle East developments will be a focus. Certainly in the G7, we had a call just before Christmas, and that point came up. So I think the answer is yes to that one.
I know we spent some time discussing this yesterday with Mr. Benjamin, but risks arising from China, in particular thinking of the estate sector, are there any signs that banks are taking steps to mitigate against those potential losses?
I'm happy to take that. It's clear that vulnerabilities in the property market, in particular in China, are crystallising and have been doing probably for the last since mid-21. What we've seen so far is a fall in activity. Some property companies, property developers have defaulted, and some of our banks that are especially active in China have been taking impairment charges, losses on the back of that. What we've been focused on from a financial stability perspective, because those have been quite contained so far, what we've been focused on from a financial stability perspective is whether what are problems in the Chinese property market might spill into the Chinese economy more broadly, or indeed into the Hong Kong property market where UK banks are more active. We haven't seen that happen yet. The Chinese authorities are being very active to support their economy, but we stress test the banks regularly for that, and we expect it to be contained, but we are confident that if it gets worse, the UK banks are resilient to it.
I think it was in the last stress test what we had a 36% fall in Chinese residential property.
Yeah. Hong Kong.
Which is a lot more than has happened.
Slowdown in growth.
Yeah, Hong Kong CRE down 50%, Hong Kong residential down 46%. So the kinds of stress tests that we apply to our banks are well beyond what we've seen so far.
As an aside, it's the second time you've mentioned 36% fall as being a stress test. Is that something you just always do?
That's a coincidence.
Yeah.
As opposed to 40% or...
We calibrate it on the basis of historical experience and think about 1 in 100 events, and it looks like that calculation led to the same number in two different contexts.
Okay, that's useful. Hedge funds. You noted in your report that since the July report, net short positioning in US Treasury futures had significantly increased from about $650 billion to around $800 billion, so what's a 23% or something uplift. To what extent is that a source of concern? Do you anticipate it could have an impact in the UK?
So maybe the most important point is the last one, which is this is obviously a US issue. We don't really see this in the sort of gilt basis trading. But of course, if the US sneezes, the rest of the world gets a cold. So, we are focused on it, as are the Fed. In terms of there's sort of two ways of looking at the US basis trade. One is that it's just the natural other side of real money buying of futures. And so when they do that, there's a gap builds up between like the sort of fair price of the future as calculated by owning a bond and repoing it, and the actual price. And then so what happens is as this widens, then hedge funds say, well, that's an opportunity. We will basically take the other side of that. It's sort of free money, as it were. And it is free money when it expires. But there's this period until expiry, when you have to sort of manage effectively a leveraged position, roll over the repo, etc. And so on the one hand, it's just a natural thing that arises, and as you saw in the charts, the size exactly is equal and opposite to the real money growth. So real money growth and hedge funds take the other side. On the other hand, it is quite concerning, as we saw in 2020, because hedge funds are sort of prone to what I've called in the past sort of jump to illiquidity. So they provide this sort of service, they provide liquidity for the market in good times when things are going well, they sort of help efficiency. But if they were to either have losses elsewhere, or for some other not be able to fund their positions, or for some other reason want to pull back, then and start unwinding, then actually they sort of cause inefficiency. They lead to an increased chance of instability. And so the question is, what could trigger that? Obviously, in 2020, COVID triggered that. That was a huge trigger, and that caused those. So now we have, a larger position, but as yet, sort of no trigger for this flip from providing liquidity to demanding liquidity. And there is one other slight mitigating factor, which is that the sort of margin requirement on those trades is now larger than it was, more than twice as large as it was in 2020. So sort of the buffer, as it were, is greater. But yeah, that's why we highlight it. It is a worry. The Fed are also looking at it. I guess it's more in their kind of wheelhouse than ours. But yeah, it certainly was something we're keeping a close eye on. And if there were to be a shock, then that is one area where it could potentially be amplified. It is a vulnerability.
One thing that we know is increasing are climate change risks, and there's a lot of work going on in mitigation to try and either adapt to it or to try and prevent it. But financial risks arising from climate change aren't referred to in the Financial Stability Report. Can you tell us why that is, and what action actually financial businesses are taking?
The biggest piece of work that we've done on climate change is our climate stress test. We did a climate exploratory scenario analysis in 2022, I think, and that gave us the best possible sense of what these future risks might be. So although it's not mentioned in this FSR, it is something that we have done a considerable amount of work on. What that scenario analysis showed was that a world with climate change is riskier than a world without one, because of the physical and transition risks that you mentioned, that those risks are building through time, and that risks are lowest with early action. And obviously we're seeing evidence of that now, flooding in the UK, wildfires in the North America, kind of CRE and buy-to-let having kind of requirements for energy efficiency. So the risks are there. What we're doing about that, and have been doing since 2019, is ensuring that the financial institutions we regulate, banks and insurers, are embedding climate-related risks in how they go about doing their business. Through the scenario analysis exercise, we got a sense, and through our normal supervision, we've got a sense of how far they've got with doing that. I'd summarise as being they've done a lot, but there's still a huge amount to do. So the firms, if you like, who are our window on these risks, are being asked to, through our supervisory expectations, to build their capabilities and help us see the risks, because of course they arise in the real economy, although they in so doing create financial risks for the firms we regulate.
Something I might follow up on separately. I'm just thinking of my time in DWP, we brought TCFD into the whole pension funds and different elements like that, because we were concerned about...
Can you just...
Sorry,
I'm getting a bit confused. There was CRE, is that corporate real estate?
Sorry, it was commercial real estate.
Commercial real estate. And
TCFD, it's Task Force for Carbon Financial Disclosures, carbon risk. TNFD is nature. and that's the new one that
Task Force for Nature.
Financial disclosures, the risks in financial due to nature and
The listening public.
apologies.
we know- we know
yes,
that.
yeah.
And on the basis that it's to encourage people who are investing money to be thinking long term
Absolutely.
about the impact of climate change. So I guess that's why I'm surprised in terms of your financial stability that wasn't in the report, but I've heard what you've said. So
And one of the important things which you may remember is that we've been working internationally to turn the climate financial disclosure agreement into a set of international standards.
accounting standards,
Yeah. I think the key challenge now is adoption of that.
Oh, okay.
That's right.
The world is not great at adopting the same accounting standards on anything,
Yeah.
actually. So there is now a set of that work went well, I thought, actually, last year. There is now a standard. It's now a kind of question of getting it adopted.
And in a UK context, we work very closely with the FCA, who are the lead authority on the ISSB, the International Sustainability Standards Board's work on disclosure, which is what TCFD has turned into.
Yeah. I've strayed a little bit from where perhaps...
No, thank you very much.
Carl's
And,
wanted to, but
and
thank you.
now, Dame Siobhan.
One's fine. UK banks made 41 billion in pre-tax profits between January and September 2023, which is double what they made in the same period in the year before. Why is that?
I think it's a number of things. I think we've certainly had, as I was saying earlier, much more benign credit conditions than was anticipated. So if you go back into the year before, banks were still provisioning quite heavily on the anticipation of COVID-related losses. Those losses, that cycle has been credit cycle has been much more benign than expected, and so they have now come to a much better place in terms of their provisioning, certainly. So you're seeing some of that. We have seen, and I know we've discussed this at previous hearings, we have seen some adjustments in net interest margins. I think the context I would put, which I think has now pretty much run through its course, actually. I think it looks as if it's stabilised more. What I would say about that is that we'd obviously gone through a period since the financial crisis where our interest rate was near zero. That had caused compression of net interest margins relative to the pre-global financial crisis position. One reason for that was that traditionally in the sort of the pre-financial crisis world, the banks would typically set their average deposit interest rates a bit below our rate. When our rate went to nearly zero, the effective rate on bank interest deposits actually stayed above our rate. What we've seen as we've raised rates is that we've gone back towards that traditional relationship. That has led to some widening of net interest margins. They look to me, and I think we've got a chart of it in the report, they are now back towards where they were sort of in the immediate pre-financial crisis period. So if you go back a bit further, they were higher, but they're certainly now back to where they were pre-financial crisis. So they look like they're back into that more normal sort of, at least pre-financial crisis, normal period. So that's contributed to it as well.
In July, this committee wrote to the UK's 4 biggest banks because they were increasing mortgage rates but refusing to pass on higher rates to their savers. Is that still the case?
So I think what happened interestingly after that was, and I would draw a distinction here, as I think I said before, between the rates they were paying on fixed term deposits and the rates they were paying on sight deposits. So it was really the sight deposits with the issue. The fixed term deposits, they actually were raising their rates pretty much in line with what we were doing. It was on sight deposits, and I say that some of it was, I think, this adjustment back to a sort of more normal relationship. What we observed actually certainly over the summer, was that the rate of change in their rates on sight deposits then started to follow what we were doing more closely, so that we saw larger increases. Obviously, we've now paused rate increases, but so that's not the issue anymore, really. But we did see an adjustment in behaviour, and so the aggregate increase in sight deposit rates, where it doesn't reflect, as I say, the totality of what we've done, it is now higher than it was back in the sort of early summer of last year.
And if I might add one thing, what we saw amongst depositors was that they were shifting their funds out of instant access accounts where the rates were relatively low into these fixed term deposits where the rates were higher. And I suspect that prompted a bit of the reaction from the banks.
And by the way, I mean, I should say that there is a deliberate post-financial crisis incentive in the rules that we have now for liquidity to incentivise banks to take fixed term deposits, because they don't run as fast, obviously, as sight deposits if there's a problem.
As you will know, Governor, from your regular attendances at this meeting, one of the biggest issues and concerns for lots of our constituents is the rate of bank branch closures. We've seen 645 closures during 2023, with Barclays having 180 of those, NatWest 138 and HSBC 114. And it doesn't look like things are going to get much better this year, with 189 branches looking like they're closing, 60 from Lloyds, 34 from Barclays, 21 NatWest and 16 Bank of Scotland. Given that the committee annual report identifies that banks are in a good state, that their profits are high, they're doing well, and it looks like they've got a good future, is it reasonable for them to be closing their branches at that rate, not only because of the impact that has on their very vulnerable customers, but also what happens in all our high streets and town centres?
Well, I think it's more of an FCA issue than a Bank of England issue directly. I think it is important, however, that banks, that people in this country have the ability to have direct access to their banks. How that's organised, I think, and by direct I don't just mean online, in other words physical, where they want it, they should be able to get it. How it's organised, I think, is a question to be answered, because changes are happening, and the banks, of course, will say, look, the footfall in bank branches has fallen a lot, and they will say this, that they're just not used as much as they were before. But I agree with you that there are people.
Except that we have seen an uptick in the use of cash, haven't we, and people depending on cash for...
well, we have. I mean, we've obviously seen quite a big fall in the use of cash, but we have actually, interestingly, you're right, very recently seen a bit of an uptick in its use. By the way, the stock of cash in circulation has not fallen, interestingly, because it's on our balance sheet, so we know. But we have, and by the way, that's why we have been very clear and continue to be very clear that we have no intention of withdrawing cash. The public want cash, the public gets cash.
Yeah.
That's absolutely clear. So I think, and we face the same issue with access to cash, because it's obviously part of the bank branch issue. I think the public has to have physical access to banking and to those services. How it's organised, I think, is a question that should be answered.
They should have free access to their own cash.
Well, costs. Look, I think costs have to be covered one way or another. Now, how they're done, I think, is a matter of should be done transparently and should be done sensibly. I'm not going to be sort of prescriptive about that. So I think the issue that the industry faces now is that I think it is important that there is physical access to these facilities. How it's organised, I think, is a matter that a lot of thought should be given to how it's best done.
And commensurate with the increase in bank profits, are we seeing an increase in bankers' bonuses?
Well, we're about to come into the bonus season, actually, so I'll probably be able to better answer that question in a few months, because it's quite seasonal, the bonus season, so don't know yet. By the way, of course, the banks, I have to tell you, the banks, if they were here, would tell you that if you look at their share prices and their what so-called price-to-book ratios, they're not. It's not a happy story.
Gosh, I don't know how happy it has to be to get a happy story. Thank you, Chair.
Thank you. Now, Danny.
Thank you, Chair. On to the juicy topic of stablecoins, bitcoins, digital pounds, and so on.
Right.
The Financial Stability Report reiterate the judgment that I think the committee's made, your committee's made before on financial risks from crypto assets. And it said that the risk to wider financial stability is limited because the exposure of the crypto asset sector to the wider financial sector is still quite small in itself. So that, which implies that there is a greater risk if crypto assets get taken up more and become more interconnected. Can I ask, and I don't mind which of you feels best able to answer, what would be your prediction for the future of crypto assets in terms of their integration into the wider financial system?
Can we just, I mean, I would start by, I think you've said it already, but I just want to share, I'd sort of answer that by distinguishing what I call unbacked crypto from stable coins. I think they're two different things, and it's worth answering the question in both.
Yeah, I want to come on to stable coins.
So let's park
crypto,
stable coins for the moment. Yeah. So this is the sort of Bitcoin type unbacked stable crypto. I think my own sense is that it's not taking off as a sort of what I might call a sort of core financial service. For instance, using Bitcoin as a payments method is pretty inefficient, and it isn't taking off much. It's no doubt used in certain circles, but it's not taking off generally. So the evidence, such as it is that I don't think the sort of the integration of it into the financial system has kept the momentum. Actually, we had a bit of momentum a few years ago. It actually hasn't kept up. But let me say two things. We have to keep a very close eye on it. Secondly, I'll say what I've said many times before. It has no intrinsic value. So I'm afraid, its value. People may want it extrinsically because they want to own things, but it doesn't have intrinsic value.
I appreciate that. I mean, hearing that there was momentum and it seems to have petered out, it might be a bit like saying in 2000 that the dot-com moment has passed. It's obviously had a big bump crypto in the last year or so, but I don't think we should assume from there that it's going to be some sort of minor niche, bit of parallel money that is somehow unrelated to the wider financial system. I mean, to look at what the Bitcoin share price has done over the last year, there's still a lot of people who do think that it's the future. Sarah, do you want to?
So I wanted to say two things, and Carolyn may want to come in as well. The first is, I think part of the reason that traditional finance has not been involved in crypto is that there's not been the regulatory framework and the infrastructure that has enabled them to do it in a safe way. What we are seeing is developments on that. The UK is putting out a regime. We've seen the SEC are considering an ETF on Bitcoin, as I'm sure you'll know. So I think we have to keep a careful eye on what is happening and ensuring that the regulatory regime is delivering a safe place for that activity to take place. But what I would say is, while that unbacked crypto is perhaps on a slower development and dependent on the infrastructure and regulatory frameworks being built for traditional finance to use it, there is great interest in taking the technology and applying it to their own businesses, and that's where the stablecoin issue comes in. Carolyn, I don't know.
Yeah, I would distinguish. I agree with the unbacked crypto. I would distinguish between that and stablecoins, but also the use of technology to say tokenize deposits or create a lot of efficiency and safety from a back office point of view. The second thing I'd like to say, though, is that even if it has no intrinsic value, there's an interest that's just out there. And so depending on, say, how the SEC or other regulators come out in terms of the products that are allowed to occur, like spot ETFs, it could still have some legs in terms of attention from some investors, speculative investors, for a while. And I think for that reason, we need to keep looking at it. For me, the future is really going to be reliant on being able to integrate with the traditional financial system. If it's going to be of any use at all, and that's where backed crypto seems to have more value.
Well, should we come on to stablecoin next? I think that's right. And in a sense, always encouraged to hear you suggest caution around unbacked crypto and people investing in that. But stablecoin is in principle safer, although I understand the stablecoins that are out there don't seem to maintain their parity with the currency they're pegged to. So they're not that stable, but nevertheless,
well, that's the issue.
We can see potentially the opportunities. Caroline says, what's holding back the development of a stablecoin in the UK, a sterling-denominated stablecoin? Why haven't we seen that emerge yet, and do you think we will soon?
Well, I think we've seen relatively limited development in all currencies other than dollars. Dollars been developing somewhat, but its use is still quite restricted. It's actually mainly used, I think, as a bridge between the crypto world that we were just talking about and the sort of conventional world. Yeah. But I think you're right. I mean, stablecoins purport to be money in the sense that they can be used, for instance, transactionally. And that's a different, that poses very different issues. At the moment, I think you're right that their value is not actually stable in that sense. I mean, in effect, they're a bit more like money market funds, of somewhat opaque money market funds as well, frankly. Now, what we are doing for the UK is and Parliament, you've already introduced the legislation, actually, which will enable the regulatory regime, and we're now, with the FCA, putting the regulatory regime together for them. Because it is very important you rightly say that when you call something stable, it actually is stable, because people have to have if they're going to be money-like, then people have to have confidence in that. Now, a good part of that comes down to the backing assets, and the question of what are the acceptable backing assets that are both stable and liquid. That's where we will for the ones that have wider use, we'll be setting out the rules on that. Obviously, there are then issues around how they're structured, the sort of the legal structure they have, and so between us and the FCA, we will be coming out with the rules. And as Sarah said, I mean, that's not only because we like rules, but also because it should enable the things. That's an enabling factor as well for them.
I would just say that there's one thing that I've noticed that's distinguished the UK from some other countries like Canada and the US, and it's the fact that because of the collaboration between the FCA and the Bank of England and Treasury, as well as the government, there's a proactive view on crypto to get the enabling legislation and then get the rules set out, which should support kind of responsible innovation in this area. And so,
yes.
And so I think the challenge for stablecoins is if you do it right and it really is stable, how do you make money? What's the business model? That's the challenge.
Okay, thank you. So, I mean, I think that reflects the fact, and it's a good thing in principle, that the UK is quite forward-leaning in this area, and they like innovation in financial services. But that brings me on to digital pound, where I'm a lot more nervous. Sarah, if I could ask you, because we discussed this at the last meeting, or when you were last here in September. Keen to hear if there's any update on the expected timing of the consultation response that we've been waiting for. When we spoke, well, let me come on to the second point. The first one is just a sort of general principle around the potential deposit limit that you were suggesting in the original consultation between £10,000 and £20,000. It's quite a big difference between £10,000 and £20,000. So I'd just be interested in views on what the appropriate figure might be, because the EU thinking about this is suggesting a far lower limit, I think €3,000. The issue is the threat of a bank run. If it's so easy to put your money into the digital pound at the first moment of danger, you can imagine people flocking into that. And as I understand it from our last conversation, the expectation is, a single the resilience arrangements that we have are such that we could probably tolerate a single bank falling over, but not a lot of them. And if all the commercial banks suddenly lost their depositors into the digital pound, we're in very serious trouble. Why it's still quite high, £10,000 to £20,000? Are you sure that you're not being this isn't a bit dangerous?
Let me answer the process point first, because when I was here in September, I did say that I hoped that we would release our response to the our summary of the responses and our response to the responses on our discussion paper before Christmas. In the end, we haven't been able to do that. We've just, as we discussed, 50,000 responses, want to make sure that we've considered them fully. We're going to Carolyn's point, respond jointly with the Treasury, and we've just not had enough time, I'm afraid, to get that out. But we very much hope to release that soon. So watch this space. On the substance of your question about limits, I understand the concern. We as financial stability policymakers are very concerned about it. I'd say we're living with that risk anyway. It comes with digital payments, never mind digital money. It was exactly what happened with Silicon Valley Bank, that if you can move your money at the touch of a button, you can move it to JP Morgan as much as you can move it to central bank digital currency. So I think we have to think about that in the round. What role liquidity, regulation, how does access to the central bank balance sheet help, as well as limits. And the reason why we've gone with a relatively high limit in our proposals so far is because we want to think about the use cases. We want to enable a salary to be paid into digital currency in order to be able to do our best possible job of understanding what the use cases will be. But we will continue to engage with the banks on it, and the similar issues arise with stablecoin as well.
Okay. I have one more question. I don't know if there's time to get in before we break.
Well,
or do you want
fire away if you can get a quick question, a quick answer.
Okay,
and then,
okay. Have you now considered the questions of privacy and programmability? Because when we last spoke, you said that hadn't yet arisen, and you didn't regard it as part of the discussion at that point. Is it now?
It is very actively being debated, and it will be part of our response.
Okay, thank you.
Right, well, since the vote has come and every colleague has had a chance to ask you questions, I'm proposing that we actually close the session now. We do have a number of further questions that we were keen to ask you, but time has got ahead of us, and so we will follow up
You want to
by
send them,
letter.
we'll happily answer them.
And I think colleagues would prefer that we adjourn now, and we will follow up by letter. So we appreciate your time, and I'm going to say thank you very much.
Thank you.
See you again soon. Order, order.
Thank you.
Thank you.